Guys, these are 5 stocks that these 5 super investors have bought. Let's check them out right now. First one, by a friend of the channel, our good friend here, Spier. He has bought American Express. Now, American Express is a company that I currently own as well. So we're pulling up American Express here. It's currently at $230 per share. A big run up from the prices I bought at. And I don't say that as a brag. I'm actually upset with that. I want stocks going lower so I can buy more shares. American Express is the ultimate in luxury cards. Now, the interesting thing about American Express is their actual percentage of overall transactions is down. Let me show you. This is the breakdown of market share of Visa, MasterCard, et cetera, from the brands from 07 to 023 based on total transaction amount. Right here is American Express, about 15 or 16%, and now it's around 11%. Okay, so it has declined, but the amount of transactions is greatly increasing, still showing an increase for American Express. And some would argue this is done for more exclusivity, which we on this channel love. Why we talk about it all the time. American Express wants to be the exclusive card for travelers and users. Exclusivity is their number one thing. So it might be driving down their percentage, but if overall it's still increasing and they are the most expensive one to have, then that can still grow a lot of value for American Express. This is a prime example of how the percentage and the piece of the pie might be a smaller percentage, but the pie is growing larger and larger. Now, these are the number of actual American Express credit cards in the United States in 2022, going back from 2013 to 2022. They combined them here. But look, you're right here. United States is in light blue, dark blue is international. And you're looking at combined here, 108 million cards. And now 133 million cards. So slow and steady growth. Over a 10-year period, it's up about 25%, which is roughly 2.2% per year. Okay, nothing insane, not great. But remember, as the world becomes bigger and bigger and bigger, and because people become more and more wealthy, more American Express will be used. All right, so let's pull up some analyst estimates on American Express. Where do analysts think earnings per share are going to go? Guys, not a ton of growth here. You have $12.50 a share estimated for this year, going to $14.68 by December of 2027. So overall, what is that? $2, and that's like 16 or 17%. Not a ton overall growth. Revenue growth, about 8% for 3 years and basically flat here. Guys, my guess is American Express will probably grow its revenue at a little bit faster pace than overall GDP growth. Because if the world's GDP is growing at 6 or 7%, the wealthy are going to spend more money. The more and more wealthy people will get more American Express cards. So my guess is that percentage will do a little bit better than overall GDP growth. So what's American Express worth to us based on that? Well, something interesting about American Express I want to show you before we get into the stock analyzer tool. Free cash flow last year, $22.9 billion. Net income, $9 billion. Last year's free cash flow, $12.5 billion. Last year's net income, $7 billion. So free cash flow is considerably higher than net income for American Express. How do you value this then? Well, I'd focus more on the free cash flow part because that's the lifeblood of the business. Dividends here, dividend yield about 1.1%. Dividends paid about 1.83 of their 5-year average. They can easily afford this dividend. So let's go check out the last time I did American Express in our stock analyzer tool. And this is what makes it difficult. I did a 10-year analysis, but look how different the profit margin is from the free cash flow. 14.5% profit margin, 37% free cash flow. In the last 10 years, 14.5% profit margin, 27% free cash flow. So you look at the saying, okay, we're so used to looking at net income versus free cash flow. Which one really applies here? So guys, our in-house analyst, Dalton, has said, Paul, I would value American Express based on the profit margin and net income. And the reason being is it's a lot like a bank. They give loans out, they get transaction fees, etc. And you'll see that right here when I go below, just to skip right to it. Look at this value for the free cash flow. What are the chances a company like American Express is this undervalued? I have low price of 400, a high price of 900. But you go here to the multiple of earnings, a low price of 200, high price of 520, middle price of 330 with no margin of safety here. So is American Express a decent buy right now? That's for you to decide. I got fortunate and bought it around 145, 150. I still want to add more shares to it. I have to do more research in terms of understanding what the true value fundamentals are, but it still seems like, is this enough margin of safety? Yeah, based on today's prices, if you believe the net income, you're looking at a 23% return based on my assumptions above. Stock number 2, owned by our super investors. Our good friend Warren Buffett has bought more Occidental. Now, guys, Occidental, it is a gas company. They own the actual fields they go in. Let me show you. So, guys, here in the U.S., Gulf of Mexico, here are the basins they actually own. They actually own these basins, and they are pulling oil from there, extracting it in order to use and sell. Now, here are the 4 countries they're involved with where they have assets in the Middle East and Northern Africa: Algeria, Oman, Qatar, and UAE, United Arab Emirates. Major oil fields. Obviously, Saudi Arabia is right here, Iraq right here, Kuwait right here, with their major oil fields mostly owned by the governments. But over here, Occidental does have some major basins in the Middle East and Northern Africa, where, as we all know, there's a lot of oil. Now, remember, guys, yes, we are transitioning more to electric vehicles, but oil's used in everyday products. It's not like if all of a sudden every car in the world was electric, we would stop using oil. There's still a lot of value for oil in the long run based on building more products. The more products we build, the more oil we need. Basically, every plastic out there has oil in it. And that's a big factor for oil companies. Now, guys, this is from January 11th, 2024. This is Berkshire Hathaway stock portfolio and what percent is made up. Occidental Petroleum, $14.5 billion, makes up 4.64%. As you all know, Apple is the big kahuna here, half their portfolio. And remember, a lot of people confuse this and think that 50% of Berkshire is invested in Apple. No, 50% of their stock portfolio. 4.6% of this stock portfolio is Occidental. But they're making a big bet. They love the way in which Occidental handles its cash flow and manages its capital. Now, guys, before we get into Ray Dalio, you have to remember, the reason these guys all do so well is they're okay looking wrong in the short run. They have the emotional fortitude. Warren Buffett will say till he's blue in every single one of these guys, if you talk to them, and we've talked to one of these. We talked to Guy Spier. They all say the most important part about investing is the emotional side. Being calm when things look bad. When a stock falls, what are they doing? This is the hardest part for investing. Investing isn't about understanding the numbers, the fundamentals. It's about saying, hey, my stock keeps declining. What am I doing here? Warren Buffett, he jokes and says, when hamburgers go on sale, the Buffett household loves it. We buy more hamburgers. That's the same way he views stocks. And that is a difficult way of thinking. It's easy when stocks are up to say, oh, I wish that the stock would go down. But the difference is news follows the stock price. As the stock goes down, the news changes. Prime example, look at Tesla. It was at $4.14 a share less than 2.5 years ago. It is now at $1.40. And guess what the news is here versus here? Tesla can't stop. I used to get into LinkedIn arguments with people telling me how much I didn't understand Tesla. Now, I have people arguing with me about why Tesla's fundamentals aren't as good as they seem. Totally different world. Why? Because the stock price has dropped big time. And that's the hard part. And this is exactly why the community was created. It was sitting there saying, we've got to be able, when we're at home alone, and I've been there. I remember back in the early 2000s, being at home watching stocks fall, going, oh my God, when is this going to end? And being so anxious and being afraid of that. It's scary to see that. And I wish I had people to be able to talk to and say, hey, what are you doing? I wish I had these kind of people to talk to. And now we have thousands of these investors in the community to talk to and calm us down. And not only that, help us with our analysis along the way. Is it worth this? Is it worth this? Is it worth somewhere in the middle? Is it worth lower than this? These are the things we have to determine in order to be successful investors. But most importantly, you're going to buy in the fundamentals, but you're going to hold and compound based on the emotion, being able to ride out the ups and downs. Peter Lynch said, I bought stocks at 12 that went to 2 and then went to 50. If the fundamentals are the same, the fundamentals are getting better, but for some reason the market has changed its perception of the company, that's where the high emotional fortitude and the understanding of fundamentals are so important. And that's why we have the community of thousands of like-minded investors. We can go in there, we can talk to, we can get calm, we can sleep better at night. You can make better decisions for your future and let your money compound. That's where you can get the most return. So guys, if you're interested in the community, click the link below. $7 for 7 days. We had our biggest sales week last week. We're going to be instituting a wait list very shortly. So make sure you get in now before the wait list starts because we want to limit the number of spaces. So again, $7 for 7 days. Click the link below. Our good friend who has not come on the channel yet for some reason, Ray Dalio, is buying Johnson & Johnson. Now, Johnson & Johnson's on my list of 33 companies I want to own. It has a very diversified group of everyday products, pharmaceuticals, etc. Let me show you how they're spending their money. Going back to 2005, this is a Johnson & Johnson's research and development budget, how much they've spent. $6.4 billion to $15 billion. Guys, they're investing in their future. It's all about the R&D. What are you bringing to market? What better products are you making to make people's lives easier and better? This is a huge factor for pharmaceutical companies. Here's even more. This is the total revenue of the pharmaceutical market going back to 2001. $390 billion all the way to $1.6 trillion in pharmaceutical spend. That's 6.4% per year. And guys, as the world becomes better, healthier, this is going to go higher. Look at it this way. I remember hearing this from Bill and Melinda Gates. Melinda Gates once said in an interview, "Can you believe there are still people in this world who die from diarrhea?" When I heard that, I was absolutely floored. I was like, there's no way. I Googled it. Oh my gosh. Something so simple. Guys, I'm not trying to be vulgar. We go to Taco Bell and you get diarrhea. There are people in this world who would literally die from that because they don't have basic pharmaceuticals. This is going to increase more and more, and it's going to be driven more and more by pharmaceutical spend in these pharmaceutical companies. And keep in mind, guys, I love Taco Bell. I will gladly get any bad bowel movement in order to have more Taco Bell. So this is no criticism of Taco Bell. So guys, here's Johnson & Johnson. It's a $360 billion company, all-time high of $186 per share back on April 25th. And guys, just this last week, it has its 52-week low of 143. Now, some interesting things. High return on invested capital, which means the money they invest in their business gets a really good rate of return, which is very important for the future. I love here, gross profit margin, 67.7%, 5-year profit margin of 24.5%, and last year's profit margin of 37%. So this is interesting. A big jump in net income last year to the previous year. So we want to check out why that big jump here. And guys, here's what I love. We just added this to our software. 3-year revenue growth rate, 5-year revenue growth rate, and 10-year revenue growth rates right here. Slow growing company. It's not going to grow a ton. It's going to grow with the economies and things like that. But it's something to keep in mind. And they pay, for all you dividend lovers out there, a 3.3% dividend eats up almost $12 billion of their $19 billion in free cash flow. And the proof that this profit margin is a fluke this last year, look at their free cash flow. It's actually lower than last year. So there must have been some gain on something they had that kind of drove this profit margin. So I'd focus on this 5-year profit margin versus the 1 year. Okay. So what are analysts saying for Johnson & Johnson? Guys, $10 per share, $10.80 per share this year, going to $12.70, which is not much growth. Even with such a high gross margin of 67%, there's not much growth in earnings per share here. Low to mid single digits. Revenue growth, same thing. Basically inflation here. So this is something that's going to be slow and steady, but people are going to ignore it because it's slow and steady and boring, but you can probably get a good return off that. So what's Johnson & Johnson worth to us? Well, let's run it through our system. The last time we did it was July 20th of 2023. I'm actually going to go a little bit different here. I'm going to go 2, 3, and 4% of my revenue growth assumptions. 2, 3, and 4. Profit margin, I went lower here, but I'm going to increase this now. I'm going to go to 17, 20, I'm going to go 18, 21, and 24%. See, that's the thing, though. Maybe I should go higher, and the reason being is, nope, because this 37% affected this 5 and 10 year. So I'm good with this. Free cash flow, I'm going to stay with, I'm going to go 19, 22, and 25%. PE, I'm actually going to go 17, 20, and 23 because I want to pay a premium for Johnson & Johnson. This is a company that's, if you told me Paul Johnson & Johnson's no longer around 10 years from now, I'd be floored. This company's going to be around. It's not a grower, but it's one of those companies that if the stock price falls more and more, they'll really do well buying back shares. So I'm willing to pay a premium for where they are. And I'm going to show the 9% return. Guys, remember, this 9% return is the market return. There's no margin of safety in here. And remember, we need margin of safety for 3 reasons, according to Seth Klarman. 1, the future is unknown. 2, valuation is an imprecise art. We don't know exactly where valuation is. It all depends on the way you're looking at it. And 3, we're humans. We make mistakes all the time. So you got to have some sort of margin of safety. So I'm going to hit the analyze button. Scroll down, and guys, based on multiple of earning, I have a low price of 105 to 110, high price of 200 to 206, middle price of 145 to 150. So it's probably selling for around what it's worth right now, is my guess based on my assumptions. Could it be higher or lower depending on how you value it? Absolutely. But the bottom line is it's not standing out to me as some obvious buy right now. But I'm going to add it to my watch list at 140 per share. Very close. Doesn't mean I'm buying it at 140. It means I'll probably start selling puts and do more research based on him on 140. Investor number 4, Michael Burry of the Big Short fame, just bought himself some Oracle. Now, as you know, I don't own Oracle, but well, maybe you don't know that. But if you're new to the channel, he also owns Baba, which I do own as well. Michael Burry made a lot of money. He's done very well. A lot of people said, oh, his Big Short was the only thing. No, he's done well since the Big Short. He is focusing on equities like he did before the Big Short. And if you remember in the movie, his investors were getting mad at him saying, we don't want you to try to guess macroeconomic trends. We want you to focus on stocks. That's what he's doing here with Oracle. So let's pull up Oracle and see what we like about Oracle. All-time high, just a month ago of 132.77. It's currently at 114. Oh, wow. It's down quite a bit in the last month. That's interesting. Down about 10 or 11%. Okay, good return on invested capital, 19% in the last 5 years. Dividend of 1.35%, $4.4 billion, only eats up about 40% of its 5-year free cash flow, which is pretty great. Another thing I love, free cash flow in the last 5 years is pretty much the same as net income, just slightly higher. That's a great thing. Good gross profit margin, 71%. What this means is for every dollar that comes in, if overhead stays the same, and there were no extra taxes, 71 cents of that would go to the bottom line. Obviously, with taxes, that's going to be lower. But that's what's incredible about software businesses. Really high gross margin can get them a good return. 3-year revenue growth rate, 2.5%, 5-year, 7%, 10-year, 3.5%. So it looks like they're probably going to grow inflation maybe a little bit better as time goes on. Let's see what analysts are saying. Let's see what the 8 pillars are on Oracle. Oh my gosh, a lot of X's here. Net income's down. Cash flow's down. Free cash flow and price PE ratio are high, and a lot of debt. They bought back a lot of shares, 22%. Wow. It's a lot of shares in the last 5 years to buy back. All right. Let's check out the analyst estimates here. So even though they have such a low growth rate, analysts are expecting big time EPS growth. When you buy back shares, hopefully smart, and you have a high gross margin, you can really drive your EPS, your earnings per share, much more, just even though revenue doesn't grow a ton. Because let's look at the revenue growth rate. Oh, wow. Actually, big revenue growth rates here. So that's interesting, guys. The last 10 years, they've done 3% revenue growth. And yet here, it's high single digits. That's interesting. Very, very interesting. All right, let's see the last time I did Oracle in our stock analyzer tool. September of this last year. Okay. So I did 3, 5, and 8% revenue growth. I did profit margin and free cash flow margin of 21, 23, and 25 for profit margin, and a higher free cash flow. Because even though, look at how much higher it is, except for this part, it is higher there, but look at the 1 year and 10 year. Big differences in free cash flow. Now, PE, 15, 18, 21 is what I probably meant to put in. Guys, is this right or wrong? I don't know. I think Oracle deserves a premium, probably because I don't understand the business as well and not as exciting. I don't give it as big a premium. But I'm going to do 15, 18, and 21. And again, 9% market return. Hit the analyze button. All right, I have a low price of 60 to 70, high price of 130 to 160, middle price of 85 to 100. This includes the dividend. So if you bought it today, you can expect about a 7.6% return based on a discounted cash flow model for the next 10 years. Guys, our final super investor, Jeremy Grantham, has bought our good friend Google, the googly moogly. Guys, Google's an incredible company. Again, news follows the stock price. Let's check this company out. When Google was up here, we were told we were crazy to say we didn't like it at 150. When it got down to the mid 80s, oh my God, you guys are crazy for liking it. This is stupid. The company is totally, the CEO needs to go. Go look at how much people wanted to kill the CEO here versus here. Now it's hitting all-time highs. All-time high was just last week at $161.70. It's currently at $155. Guys, great return on invested capital. Great Look at this. Free cash flow last year of $70 billion. Guys, keep in mind, this is a little bit more than Microsoft did in free cash flow, and yet Microsoft's market cap is 40 or 50% greater than Google. That's what's interesting. They have 24% basically consistent profit margin, 57% to the bottom, to the gross margin. Big time revenue growth in the last 10 years, understandable. Why? Two major components, online advertising and their cloud computing services. Let me show you that breakdown right now. This is going back to 2017. Cloud computing right here. Google Ad Services right here. Obviously, as you see, as a percentage of revenue, Google ads are going down, but the pie is getting a lot bigger. Again, this is not an example of their ad services are declining. This is a misleading chart because look at their cloud computing. Much bigger chunk here as time goes on. High margin business, and we love that. They're not as big as Microsoft is on cloud computing, but they're growing in their infrastructure and making a big dent in cloud computing services. Google owns the top 2 search engines in the world, google.com and this very channel you're watching right now, youtube.com. Here are the 8 pillars on Google. Check marks all around except for the 5-year PE and 5-year price to free cash flow. But guys, at 35 times, the question is that reasonable? Guys, if you can grow your revenue and profit a huge number every single year, why would you not pay a premium for a company? Of course you would, especially somebody like Google. Who here in this world says, oh, I have a question, Bing it? Who says Yahoo it? No, you say Google it. That's what's incredible. They own the world of search. If you want to learn something, where do you go? Go to YouTube. That's where you go. Guys, if you'd been 20 years ago and I said to you, go learn how to renovate a bathroom, what would you have said? Let me go find a tradesman who can teach me. Now with Google, you could literally go in there and say, how do I renovate a bathroom? Now, I'm not saying you're going to be great at it, but you can even start there. Google used to run a great ad on TV where it was about people who had professional careers that got their start from learning on Google. But they all of a sudden said, I really love this. Let me go get a better start. Look at our community. Look at our entire area we're doing things here. It's all based on YouTube and Google and where it started here. That's what's incredible about Google and YouTube. So let's go check out the analyst estimates here. EPS of $6.88 per share this year, going to $13.14. Mid to high double digits. That's incredible. Let's look at revenue growth. Basically high single digits, low double digits, going from $350 to $505 billion in the next 5 years, according to analysts. And guys, remember, whenever we talk about analysts, they're biased. You've got to remember that when looking at analysts. They're going to be biased in their own ways, just like you and I, probably even worse because they have career risk. But again, it's a nice way to sit there and gauge what's reasonable. So let's pull up Google in our stock analyzer tool. We did it just a month ago. 10-year analysis. I did 5, 8, and 11% revenue growth. Might be light, but I'm okay with that. Profit margin, 22, 24, 26. I did the same thing for free cash flow, my low, middle, high. PE, 20, 23, and 26. I think Google deserves a premium. Is this reasonable? I don't know. If you told me 15, I'd say that's not reasonable. If you told me 30, I'd say, it seems a little rich. 25 might be okay. I don't know. I just look at it going, this feels about right to me. And I did a 9% market return. Hit the analyze button. Guys, 114 on the low side, 260 on the high, 173 in the middle. You can probably get a pretty decent return by buying Google, but you have to do it based on what you prefer. Guys, if you like this video and you want to see the other 33 companies I want to own, watch our next video. And don't forget, community, $7 for 7 days. Click the link below.